How's it going? My name is Ben. I made a couple other videos labeled Devil's Advocate Market Collapse. This one is just going to be labeled Market Collapse. I checked those out before you watch this one. This is the final video you should watch, and obviously a more risky assessment given historical performances. Nonetheless, I'm going to make a case for a market collapse. And so here goes nothing. Once again, using the same chart as before. Now, in this example, what we're looking at is basically people who are short selling the market and whether they are making a profit or losing. And the number one thing we begin to see is that there are a number of traders, small traders generally speaking, who are continually blowing up in the market, and they really begin to jump on the bandwagon toward the top. Now, generally right about the top, specifically in regions like, as you can see here, right at the very top, and in regions, like here, right at the very top. Investors, very, very talented investors, tend to pigpile onto the shorts, and as a result of their shorting, they actually change the entire negative credit balance in the shorting margin accounts. And as a result, in a very short period of time, the credit balance goes from being severely negative to being neutral, and then even positive. And this actually tends to happen before, as you can see, before the market even really finishes collapsing, or even sometimes even begins collapsing. Right now there is zero, and I will repeat that, zero evidence of that happening. But I will note that the negative credit balance is quite large. I will also note, however, that a small pullback, such as this, right, can end up triggering the credit balance to move all the way back to neutral. All right, but as I will show in the other videos, and maybe you guys have already seen, hopefully have already seen, and if you haven't, then you really need to go fucking watch those videos. Each one of these large pullbacks is related either to a credit event or the end of QE. This is related to a credit event that occurred in 97 and 2008. 97 and 98. Then this is another credit. This is the tech bubble. As you can see, they've written tech bubble here. And then there's this one here, which is related to the end of the Japanese QE. And then this here, of course, everybody is familiar with. This is the housing bubble popping right here. And then this one here, everybody is familiar with the end of QE2. This is the end of QE1. And QE3 and 4 were pretty succinctly followed, so I wouldn't say there was any sort of large pullback. Why we haven't really seen anything, pulling us back to neutral here. Now, that doesn't mean that this isn't the top of the market. All it means is that the only thing that can really bring us down at this point is a credit market, quote-unquote event, collapse, some sort of moment where the credit markets suffer severely. That or an end to QE appears to tell you the truth. The end of QE oftentimes doesn't appear to do that much damage, especially back here. This little dip here, this is the end of the Japanese QE. However, post 2008, the only thing that actually kept the market going up was the continuance of QE. Now, I would note that QE was ended on a high note and begun on a low note. I'm not so sure that QE has as much power over stocks as everyone assumes. It could be more of like a foolish kind of thing. I believe it has more power over the credit markets. And as was shown with the 5-6 year period of Japanese QE, it doesn't really create a lot of inflation. And neither has this 5 years of Fed stimulus created much inflation. So I think, a lot of people are speculating that with all this money out there, it's going to inevitably cause inflation. And I believe they're correct about that. I believe they're certainly correct about that. But right now, none of that money is making it into the hard economy, the Main Street economy, and I believe that stocks have become exuberant. Believing that they're going to front-run inflation, and all I can say is that, if they haven't already front-run inflation for like the next year, like what? It's been 5 years and we haven't had much inflation. This seems a little bit premature. If you're front-running inflation, this seems premature, and pretty much all of it seems very premature. If we're front-running inflation, we haven't really seen any major signs of it. I know inflation happens quickly, but more than likely, this is showing a distortion between credit and stock market, credit markets and stock markets. And so this is the chart I'm going to show you here. Now take a look at what is happening to the S&P, or we'll just call it equities, and this down here, investment grade corporate index. Okay. Now, as you can see, the investment grade corporate index stays mostly below 100, and then flies up to 160, 150. And stocks start taking a little bit of trouble here, and then they begin pulling back. And instead of really continuing downward, the credit market just kind of hangs flat and then zips back up, and subsequently the stock market collapses. So they're happening succinctly. It's not the credit market is going first and then the stock market. But as you can see, in this instance, the credit market starts going first. So you may be wondering, what is keeping the credit market up? That's going to be QE, keeping the U.S. bond market bubble up and really restoring faith in the credit worthiness of the markets. Now we have a lot of debt bubbles out there. One of them, for instance, being student loans, and a lot of people will go, student loans can't blow up because most kids are trying to pay them back. The question is, can they in the future? And I think that's a definite no, a resounding no. But they can't really default on them either. So I'm not really quite sure. I think that's it ends up being neutral somehow. People are going to stop paying them back, and the delinquency on them will go up, and I'm not quite sure how that's going to affect the value of these, debt loads. But you can't default on them. Not for well over a decade. However, I will also bring up that Zero Hedge has pointed out that it's not really. It's at this point, it's really more of like a corporate PIK toggle debt, and a lot of buybacks and such things. I'm going to do more reading about that and maybe post another video. So subscribe to keep watching. I'll try and explain what a PIK toggle credit bubble is, and you can see PIK toggle credit bubble. Obviously, a lot of people say it's never different. It's always different. QE changes a lot. Credit bubbles being larger than they were before changes a lot. QE forever changes a lot. Everything is different this time. Everything is different. HFT, well, not really. HFT doesn't really change anything. All I can show you, right, is that credit bubbles and QE bubbles, right, or the end of QE. These are what cause negative credit balances to become positive credit balances. And positive credit balances seem to be very good at preceding market falls. Now, the last time we saw a large spike in the S&P and credit stayed, flat to the same, right? Credit eventually began moving up and the market began moving down. And that kind of stirred a little bit of a panic. Now, I will remind everybody that there was no QE, that this debt cycle, right, was very prolonged for really no good reason. Whereas the current one we're in is mostly, as Zero Hedge notes here, mostly QE induced. All right. Now this chart here is obviously really blowing this up to look a lot bigger than it is, maybe a little bit scary. You'll see on the axis over here we go from 100 to 240. Okay. So, over here on this scale, we're dealing with, something on a much smaller scale over here. But nevertheless, there's a chart of this. The issue with the credit spread on high-yield corporate bonds, for instance, will help elaborate. This is that, very low, what we'll call low yield period, and a relatively stable period in the credit market. And then we run into a very turbulent period, and it's stayed quite turbulent, and we've been pulling back, but and yes, it can stay artificially low for a long period of time, and this is what I worry about. And when the Japanese QE ended, did that lead to this? I don't really think so. I think it was more the housing bubble popping. But could the Fed QE, which appears to have a lot more power, considering, for instance, the world reserve currency is backing this? I don't know what that really matters for anymore these days, but it appears that the Fed is able to calm credit markets for whatever reasons I don't quite understand. They're able to calm them a lot more. And that can definitely cause stability in the credit markets. But what I will say is the last time we saw a great divergence between stocks and credit, right? When they finally did begin coming back, they went back all the way. I will, however, say that QE was not on the table. And you may say, well, how does QE change things? QE basically means that the Fed is printing money in order to keep credit markets liquid. ZIRP, for instance, is working to keep credit markets liquid. And can this liquidity continue for as long as QE continues and for as long as ZIRP continues? Yeah. Up until we have, hyperinflation, inevitably, eventually. There's no doubt about it. That'll eventually come. How long it will take, I don't know. One thing's for sure is that quantitative easing, if indeed it even does cause any freaking inflation, it is delayed as hell. But there's no doubt about it, it will be causing inflation. And so that's why I like to play devil's advocate. I like to point out the fact that I believe that QE, and as Zero Hedge points out, likely in increasing QE is going to keep credit markets fully liquid, fully stabilized, and it's going to spark fears of inflation, which is going to drive equities higher. I'm not saying that there can't be pullbacks, and there can't be even large pullbacks. We could have another, almost 20 or even 30% pullback, but I don't believe that we need a major credit panic or an end to QE. And if the Fed is performing QE, it seems slightly hard based on historical performances here. It seems slightly hard for that to occur. And so that's why I would describe myself as being not such a bear anymore on the stock market. I have been bearish at times, and I have, definitely told people that, I think shorting the market, or at least going long volatility, is a good idea. But I've never advocated, a market, shorting for a market collapse. I don't think that is something that you should do, considering that QE may never come to an end. But what I will say is that if this is front-running inflation, I feel like they're jumping the gun to a disgusting amount, and the market is, in my opinion, quite close to resembling Tesla. And there's a lot of speculation that hasn't really, seen the effect just yet. So I hope that helps. Once again, I'm just, giving you guys the devil's advocate side of the story and the bear side of the story. I hope this helps. Take it easy.